So good morning, Ken.
Morning, James.
Thank you very much for doing this again. It's a while since we've heard from you, so we're quite keen to get an update on what's been going on with Studio Capital. I know the performance has picked up. So, but as usual, I'm going to let you sort of talk through what the fund's trying to do first, please, and then we'll come to some questions. So if anybody's got any questions, just put them into the chat function of YouTube. Thank you very much. Over to you.
Okay, thank you. I'm Ken Wotton. I'm Managing Director for Public Equity at Gresham House Asset Management, and we are the manager for Strategic Equity Capital PLC, which we refer to as SEC to make it a bit easier and less of a tongue tire. So just quickly give you a very high level overview of Gresham and the platform that we have, and specifically sort of dedicated to our equities business and SEC, and then I'll talk a bit about fund strategy and then a little bit about the companies and the market environment and some outlook comments. So hopefully I can squeeze that into 10 minutes or so and then leave time for questions. So Gresham are a specialist alternative asset management company. We've got about £8.5 billion worth of assets under management, of which just over 2 is in equities. The rest is in various strategies and real assets. Within our equities business, we have both public and private equity, and that's really relevant when we come to talk about what we're doing with SEC. If we flip to the next slide, then we'll just sort of give you a sense for the sort of depth of the resource that we have at Gresham in our equities platform. So we have 5 of us who are dedicated to investing in public companies with a real bias and heritage in smaller companies. We have 22 investment professionals investing in private companies. We've got this pretty distinctive crossover capability between public and private, which really we think provides significant synergies when we're trying to assess companies, when we're trying to get involved in managing those businesses post-investment, and then also when we're trying to sort of join up our network of people that we know to help us to sort of get better insight, to get sort of more effective and better people to get involved with the companies where relevant. We have a very experienced investment committee, which comprises of our group chief executive, Tony Delwood, and then 4 independent non-executive members, and then the whole kind of set of group functions and advisors around the business that you would expect. So a really well invested platform, and beyond the platform, so as well as the people we have in the business and closely aligned to it, we also have what we describe as our sort of powerful private equity network. So this is the combined network of people that we know and work with externally, both through the public equity team, the private equity team, and the wider Gresham House. And this is really, really key to our investment process. And fundamentally, this is about having a pre-qualified proprietary network of people that we can go to help us with our due diligence process when we're evaluating new companies. So trying to find experts that colleagues know and trust, and who have genuine expertise in a particular area, because they're operators and they're independent, and we can use those people to help us to validate the judgments we're making on investments, and where relevant, we can get them to get involved with those companies in some capacity, either as non-executives or as consultants or as advisors. And when we come to talk about SEC strategy, this will become more apparent kind of quite how valuable this is, and we think it's a real competitive advantage, which is very difficult to replicate. So let's talk about SEC itself. So this is a very concentrated, smaller companies focused investment trust, high conviction ideas. If you flick onto the next slide, there's a few sort of bullets about what we're trying to do. It's just over 150 million market cap, around 170 million of net asset value, so sort of trading at a slight discount. Essentially, this is a highly curated, very concentrated portfolio of UK smaller companies investments, typically between 15 and 25 investments. We've currently got 17. the majority of the value of the portfolio sits in the top 10. Currently, that's about 80% of NAV is in 10 companies. So it's really those 10 companies that will drive the value over the next sort of 3 to 5 years. We talk about having a sort of proprietary strategic public equity strategy. And that's all around trying to take a private equity style approach to investing in public companies. And I'll come on to what we mean by that. But we think we're very well set up to be able to deliver that strategy because of the public-private crossover capability we have within the platform of Gresham. And we've got a very long track record of doing this successfully across a number of different products. As a result of that differentiated strategy and the highly curated portfolio, the correlation of this strategy and this fund to the overall stock market and also to other peer group funds within the investment trust of the UK small companies sector is very low. So you're not really buying, if you buy this fund, you're not buying UK economy, you're not buying UK small cap necessarily, but you're buying a very specific and differentiated strategy, which we think really fits the investment trust vehicle structure, closed-end structure, because we can take larger equity stakes. And you know, this fund, we believe, really deserves to exist within the investment trust space because it's not, unlike some others that are out there. You can't get a directly comparable open-ended equivalent. The closed-ended structure really suits what we're trying to do. And this kind of shows you, we sit somewhere in between typical public equity, where generally the funds are they have a large number of holdings, are very diversified. They're typically quite passive in terms of the interactions that the managers have with the individual companies. Individual holdings don't necessarily move the needle that much, and typically they are sort of focused on relative performance against an index or a benchmark. On the other side, private equity, very concentrated, very high touch, very active ownership, but highly illiquid, because these are private companies, and typically the liquidity comes when the whole company is bought or sold, and often there's significant use of gearing in the capital structure as well. So there's a kind of risk component to that, particularly relevant in the current market environment, economic environment. And then we sit somewhere in the middle, so still concentrated. We take significant minority stakes, so what we think we can use to build influence and engagement, but without control. Very low gearing, and no gearing in the fund structure itself, but still an attractive return target. And because the companies are listed, or predominantly listed, we have got flexible access to liquidity, even though we may be less liquid than a typical public equity fund. Is much more liquid than private equity, and we can use that to take profits in the market, so partial exits, or potentially to add to our positions if share price sort of gets detached from the fundamentals. So we think the best of both worlds. And as I said before, the portfolio is concentrated. The majority of the value, 80% at the end of the last quarter, in the top 10 holdings. So you can see various logos here. I won't go into the detail of all these companies in this presentation, but happy to take questions on specifics. But we focus on UK small cap listed, typically low capital intensity services and technology focused businesses. So we're ranging from actuarial consultants, a technology company selling into IFAs, a data center and IT managed service provider, a wealth manager, engineering environmental consultancy, a lettings focused franchise estate agency chain, a video games developer for indie games, software into higher education, ESG and energy consultancy, and a business that's a bit of a special situation, Trufin, which is selling. It's got a number of different businesses in software and technology. So quite a sort of eclectic mix. All of them high conviction, and all of them, importantly, where we think there's an opportunity for us to actively engage with the management teams and the boards of these businesses to help to support and to drive value. And that's really important in the current environment where we've got a sentiment-driven market, where valuations are depressed, where you're not getting market beta in returns. We're trying to drive absolute returns by the stock selection, and then getting sort of actively involved with those management teams to help them to drive value, even when the overall stock market might not be supporting that. And the aggregate, we think if you had to sort of give a high level view of what would you be buying if you buy this trust, it's the characteristics on the right hand side in the table there. So these are businesses that in aggregate are growing 10% at the top line. So decent revenue growth, which is pretty attractive in the environment where the UK economy isn't really growing that much. They are high margin businesses, so well over 25% average EBITDA margin, so really sort of good indicator of the quality of the underlying businesses. EBITDA growth, which is almost 14%, so profit growth faster than revenue growth, so operational gearing sort of positively impacting earnings. And then financial leverage is really quite low, so 0.4 times net debt to EBITDA. So the combination of all those factors, I think, growth businesses, high quality, low leverage, means that you're not only getting good quality companies, but you're also getting more robust, resilient, and less risky businesses because they don't have much financial leverage, if any. Some of them are net cash. And in this environment where there's lots of uncertainty and where things can come out of left field that companies weren't expecting, having strong balance sheets are really, really important. And all of that you can buy on an EV/EBITDA multiple of on average of just around 9.5 times, so single digit multiple. And then that compares to transaction multiples where we're seeing companies getting taken out, and we're seeing a lot of that at the moment, which are sort of significantly in excess of that multiple. So we can see a real margin of safety on valuation for these businesses. I won't go through this in detail, but no, we took over the management of the fund in 2020. I took on lead manager role in September 2020, and there's a bit of sort of reshaping of the portfolio to be done over the first 12 months. But we really think the strategy is starting to work really effectively now, and that's now coming through in performance. I'll let you sort of look at that at your leisure. And it's just worth talking about the market backdrop. So, well, why are we optimistic when everyone seems to be very pessimistic about the UK stock market? Well, there's two ways of looking at that pessimism and the current sort of lack of favour, kind of lack of interest in the UK stock market. And we take a bit more of a glass half full approach or perspective on it. If you look at the left-hand charts, that's showing you that the UK just keeps getting even less sort of in favour relative to global equities, particularly the US. And you see that the forward PE multiple of the UK market overall, it's at the lowest point that it's been since 1992. So it really that's reflecting the fact that there's been flows out of UK funds, 34 consecutive months now, I believe, and flowed into the US. So UK looks on the face of it very undervalued relative to history and relative to other markets. On the right hand side, you can see that within the UK, the smaller you go, the bigger the discount. So below 500 million pounds market cap, which is where SEC is really focusing, you've got discounts of sort of between 25 and almost 40%, depending on the scale. So big opportunity for value if you pick the right companies. And so when people ask me about the negative views that we're seeing about the UK market and how I feel about that, I feel pretty good about it because it's creating a fantastic set of opportunities for us. And for a strategy like SEC, there are high quality businesses listed in the UK in the small cap universe, which are trading at unprecedentedly low multiples. And we can benchmark them against history. We can benchmark them against sort of other developed stock markets, but we can also benchmark them against the multiples that private equity or corporates are paying to buy whole businesses in private markets. And that discount is the widest that I can remember seeing it in my career. So that tells me that there's a dislocation in the stock market, but we can buy great businesses, and if the stock market doesn't re-rate these businesses over time, then there's going to be M&A activity which is going to try and sort of exploit that gap, and that is what's happening in the market at the moment. And here we go. So we have been the recipient of a sort of pretty large number of takeover approaches for portfolio companies in SEC over the last few years. So this is showing you since September 2020, when I took over managing the portfolio. We've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 portfolio companies that have had either approaches or have been taken over. That's 20, we've had 25% of the portfolio holdings by number, so the names that we've owned over that period have ended up being taken over. It's just that those companies have contributed not far off half the returns that we've generated since that period. And remember that 9.5 times multiple that I mentioned earlier on, which is the average the current portfolio is trading on. Well, that compares to 13.8 times, which is the average multiple for the companies that have been taken out from the portfolio. So that gives you a really good sense of the margin of safety on valuation that we've got here. And that's the opportunity, as well as the sort of quality of the businesses and their ability to grow and generate cash. So that backdrop, that's a fantastic backdrop for our strategy, because we can find high quality businesses where we can see catalysts for value creation, where we can leverage our network and our Gresham House platform to engage actively with the management teams and the boards of these businesses to support that value creation strategy, and to really ensure that it's focused on and that it can be delivered. And we don't want all our companies to get taken out, and it's a function of the market environment at the moment that's what's happening, because of where valuations are. If you roll back to 2021, when we were in a bull market, we were getting exits for businesses by selling in the market at what we felt were very high prices. So this is a flexible strategy. At the moment, takeovers are a kind of key source of alpha generation for us, but in a different market environment, we've got the flexibility to sell in the market as well. We think the strategy is distinctive. We think now really is the time where it can be hugely effective. The opportunity set is really, really exciting. And so whilst all the commentators are very negative on the UK and UK small cap, and kind of people aren't listening, we really think there's a fantastic opportunity to create value. And then, so just in terms of outlook, what changes the picture, what changes the dynamic for the UK market? I really think it's this valuation disconnect between not just the UK and other markets, but UK listed companies and the private markets. And it's something we've spent a lot of time analysing and thinking about. That gap, that arbitrage, that opportunity is there for private equity. That's why there's lots of public to private transactions backed by private equity happening at the moment, is because you can look at some of these businesses are trading at half price compared to what private transactions are happening at. So that's really attractive for private equity. It's really attractive for corporate strategic buyers as well, because they can get hold of attractive assets at what they see as pretty attractive prices if taking a long-term view. So I think that the more we continue to see this happening, the more it shines a light on this valuation opportunity, and that will be the catalyst to change the direction of travel in terms of flows into UK funds, or go from out to in. If you go from out to in, history tells you that you create marginal buyers of these shares, and they can move up quite quickly, and you can get a very positive re-rating. And looking back at the history of sort of small cap sort of bear markets, and then the recovery year can be really very, very strong and very rapid. So that, I think that will happen at some point, but we don't need it to happen for our strategy to work, because we can be proactive about trying to drive value from the investments anyway. So I'll stop at that point, and I'm happy for James to sort of direct any questions that people have.
Sure, great. Okay. A couple of things about sort of the process then first, I think. So firstly, just to bit more information on how you actually pick stocks. So, I mean, I'm curious to know, like, what the sort of pool of things that you've got bubbling along in the background is like. I mean, how many opportunities are there?
Yeah, so we have very active screening process where we're trying to screen for the market within the sort of market cap range that we're targeting, for financial indicators of quality. So we'll screen on things like revenue growth and margins, return on capital, and yeah, and balance sheet strength. But really, as a kind of as an indicator, rather, we don't have sort of hard limits on those things. We also screen on valuation multiples, on P multiple, EV, EBITDA, free cash flow yield, etc. To give us a sort of long list. And then, you know, a lot of these companies we'll know already. Some of them we may have existing investments in through our open-ended funds at Gresham, so we know the businesses pretty well already. And then we're looking for a catalyst where we can get some liquidity to get a meaningful equity stake in these businesses. And if we can do that, we then see that as a platform for us to be able to engage. So we have to have a really clear view about what we think the value creation strategy should be. And then once we've bought a stake, we'll then iterate that by talking to the management team and the board to really try and hone it and try and get an agreement that what we think should happen is what they think should happen, and then we can support it. In terms of the pipeline and how many companies we have, you know, we have an active pipeline at any given moment. They'll probably have sort of about, you know, a dozen names which we're sort of in the process of doing work on. But the way we structure the portfolio also there's a natural pipeline there. So we have a portfolio of somewhere between 15 and 25 names at any given time, with the majority of the value in the top 10. So the ones which are outside the top 10, which are, to remind you, is 80% of the value at the moment, the ones that are outside the top 10, they're effectively the toehold positions. That's the kind of natural pipeline. These are businesses that we like enough to, and where we think that the opportunity is sufficient for us to take an initial position. And that's partly about having a stake so we can engage more actively with the management team, learn more, do our DD, and with the sort of potential to build the stake. But equally, it's, if we spot an opportunity, you know, we don't want to miss out on that opportunity because we haven't had the opportunity to buy as much as we wanted yet. So at least we've got some access to that upside if it happens quicker than we thought. So there's a natural pipeline of, you know, any given time. It's probably 10 companies that on average that we would have in the portfolio, but at a smaller weighting.
Fair enough, thank you. Obviously, you've got quite a concentrated portfolio. So there's a question about managing the risks around that. But I think, I suppose the curious thing from my point of view is, like, what would you do if you decided something wasn't working and you needed to get out? Given the sort of percentages that you own of companies, what can you do?
It's very much case by case. I mean, we are, you know, our heritage is in small microcap investing. It's, you know, I would describe it as less liquid rather than illiquid. So it's the less liquid part of the market, but, you know, there is liquidity. These are listed companies. So, and part of our specialism is sort of, you know, operating in that part of the market with these kind of positions. So we've been doing that for a number of years. So it really is case by case. So in some situations, it will be selling into the market, and we may have to be patient about that. If we're really worried that value is going to be destroyed rapidly, we might sort of take a view on price to get out, with a sort of view of avoiding a bigger sort of negative impact later. But equally, we might sort of push for the whole company to be sold if we think that's the best route to our liquidity, and that we think the thesis is not quite playing out, and we have a large stake, then we do have an influence, and we will engage not just with the board, but where relevant with other stakeholders as well, to sort of articulate our views and hopefully get support for anything that we're pushing for. So it really does vary. I guess the liquidity is one side of it. The other side is influence, and you know, we do have, if we have a big equity stake, that gives you a voice in things like a takeover situation. So we can either enable takeover to happen in a scenario where the approach and the price is really attractive. But we had one of those in the portfolio. It was our largest holding at the sort of beginning of last year, Medica, which is a healthcare services provider, and we had an aggregate 20% equity stake in the company. There was an approach, and that resulted in a full exit at what we thought was a very attractive price, which had been sort of very actively benchmarked in the market. In a different situation where we've got a large equity stake, there was an approach which hasn't been public, and we didn't like the price, and even though it was a premium to the price on the screen, and because we weren't supportive of it, it never came to light because the board didn't feel they could recommend it without when they knew we were opposed to it, and the potential buyer sort of wasn't able to kind of guarantee that they could actually get the deal to happen if we didn't support it, so it didn't happen.
Cool, thank you. Obviously, you can sense that it's all quite involved. Just because there's a specific question here, which you might take offence to, but it's asking about why the fees are so high for a fund that's so small and concentrated. But I'm guessing that you're doing an awful lot of engagement. There's an awful lot of ongoing work you're doing, even beyond just looking for stocks.
Yeah, I mean, I would argue the fees are not high because the management, the average the annual management charge is 75 basis points, which sort of is lower than other funds in the market that have sort of more active strategies, and much lower than private equity. We do have a performance fee on the fund if we're successful, but we believe that's aligned with shareholders. So if we're successful, we'll benefit from that. But you're absolutely right. The resource that is devoted into these sort of these situations is greater than a typical sort of public market fund manager would do, because we're actively engaging with the businesses, and so almost the concentration risk increases the resource requirement rather than the other way around.
Yeah, I understand that. Cool. So let's have a look at some specific holdings if we can. So, well, the first one is, what's the attraction of XPS? I think, so given that it's the largest position.
Yeah. So XPS is as it says on the screen, a pensions consultancy business. So it provides actuarial services, investment consulting, and pensions administration services into mainly the defined benefit pension world. So you might think that's not the most exciting market because it's there aren't many sort of open schemes anymore, and the sort of DB schemes are a sort of dying breed. Well, it's not actually true, because there's extremely large amount of money still in schemes, and those schemes have to be administered, and they have to navigate regulation, and they have obligations to their members and their pensioners to do various things. So there's an ongoing requirement for valuations and advice around how to deal with certain regulatory sort of initiatives. And you can imagine that things like the LDI crisis at the back end of 2022 has created a great deal of activity from pensions trustees to try and ensure that they're positioned correctly, and that the regulatory sort of scrutiny on the sector that's coming down the pipe as a result of that is going to be navigated properly, and that all requires specialist advice, and that's what XPS is doing. So it's not a cyclical sector; it's a structurally sort of attractive sector in our view. It's growing. The company grew to 20%. So the year to March, they put a trading statement out the other day. So 20% top line growth. I mean, that's pretty attractive growth rate in a boring sector. And it's a very profitable cash generative business. It's been a beneficiary rather than a sort of being hurt by inflation. So it has index linked contracts in a lot of cases. So it actually is able to put its prices up under the structure of its contracts and in line with inflation, which when inflation is high is very good for them. and pays an attractive dividend yield. So, all of those characteristics we think are really attractive. And then the last thing is, from a valuation point of view, this is a company that on a current year basis, the sort of forward-looking basis, is still trading on single-digit EV/EBITDA multiple, and that compares not just sort of favorably versus the company's own history since its IPO, but also if you look at transactions that have happened in this sector, this has been a sector which has been very active from a private equity point of view. So there's a number of different players in this space that are owned or have been bought and sold by private equity in recent years, and trade for that matter. And the range of multiples for those transactions in recent years has been between 11.5 and 17 times EV/EBITDA. So you've got a business here which is trading at, I think it's about 9.5 times, and so actually broadly in line with the average for our portfolio. And the transactions in the space, for many of them, for smaller and arguably sort of lower quality businesses, have ranged from 11.5 to 17. So that tells you there's a good margin of safety on valuation for this business as well. Yeah. We think the sort of attractions of the business model and the operating momentum, they've had forecast upgrades over the last year or two, that should drive a re-rating in due course from the stock market. But if it doesn't, then clearly that gap with private markets is an obvious opportunity.
Great, thank you. All right, Team 17 next. Mm-hmm. So one thing that's obvious from that is your stake in that is relatively low compared to everything else. So thinking the thinking of that.
So this is
around the share price is going down. And did you put more money into it, and why?
Sure. Yeah. So Team 17 is an indie video game developer and publisher. It's a business we've known since its IPO. In fact, so we had interactions with them prior to the IPO. And within a sector which has had a fair bit of sort of turmoil recently, the video game sector has been an absolute powerhouse of growth for many years, but a lot of businesses benefited from the COVID period where people at home had more time to play games, and so valuations went sort of sky high because performance in the sector was very strong. And people were extrapolating the growth rates that we saw in COVID sort of out beyond that, and that didn't transpire to be accurate. So there's been a lot of kind of profit warnings in the space, but including Team 17. So we bought our stake in this business after it had a profit warning, and a material downgrade. I won't go into the detail of it, but we believe that downgrade was a result of one-off factors which are transitory and they don't really impact the long-term fundamental opportunity this business has. And we like it relative to other companies in the sector because it's much more diversified. So there's no one game which it sort of dominates its revenue, whereas some of the competitors, they're really very hits-driven businesses. And you put a lot of money into one game and it's either successful and you've done brilliantly, or it isn't and you haven't. And we don't like that volatility. Whereas Team 17 has a very significant portfolio of smaller games, big back catalogue, and most of its revenue comes from the back catalogue rather than from new games that have to be successful. So we like those characteristics. You mentioned our equity stake. This is a pretty new position for us. We bought it sort of second half of last year. And we are still sort of building our thesis and there is scope for us to potentially increase our position and our stake in due course. It's also there's been some changes to the team there. So a relatively new CEO, the founder who sort of built the business, who was CEO up until last year, has stepped back to non-exec. There's a new chair coming in who's actually someone we know really well and have backed and made money out of in a different business. So we think the pieces of the puzzle are coming together there, and we are sort of in the process of building rather than sort of viewing that stake as our kind of final position.
Great, thank you. Hang on, there we go. What was the big driver of the outperformance in Q1?
Well, the main driver was the two companies that sort of really made a difference in Q1 were XPS, because it had a sort of trading update which indicated it was ahead of expectations for the market from the market, and so forecast upgrades, and it's a big position in the fund, biggest position in the fund, and Fintel, which is the second largest position in the fund, which is again it's a business which has got really strong operational momentum. So the forecasts are sort of going in the right direction, and that's been sort of driving the share price. So those are the two kind of notable things which have driven the last 3 months. But we sort of take a long-term view. So this is typically a 3 to 5 year holding period for an individual investment. So it's nice to have a 3-month sort of positive performance number, but really we're focusing on the longer term numbers in terms of how we want to be judged.
Great, thank you. You talked about takeovers.
Mm-hmm.
Do you think things are being taken out at the right price, or do you think they're being taken out too cheaply?
I think it's a real mix. So you've got this gap that I mentioned before about in terms of the valuations of UK listed small cap companies and similar businesses when the whole business changes hands in private markets, and that benchmarking between public and private is something that we feel we're very well set up to do, because we've got a private equity business and this kind of private equity approach, but also it's something we monitor very proactively. So there's a big gap at the moment, and that's sort of making private equity, not just private equity, actually quite a lot. I get asked quite often, is there any themes to the takeovers you're seeing in UK small cap land? And the answer is the main theme is that small caps across lots of sectors for high quality businesses are trading at big discounts. That's the theme, because the buyers are coming from all over the place. There's UK private equity, European private equity, US private equity, and then the same for trade. The US trade, European trade, UK trade that are sort of seeing value in this part of the market. So to your question about a company's getting taken out at the right price or the wrong price, it varies. It really does vary. And so if you look at the logos at the bottom here, these are companies that have been either had approaches, or most of them have actually been taken over by private equity, that were companies that we owned in this fund. And if you look at the one that's given the biggest contribution to the returns for our shareholders is Medica, which I mentioned earlier, where we felt the price was the right price, and we'd sort of encouraged the board of the company to get proper professional M&A advice, because we knew there was sort of private equity and corporate interest in this space. So it was a teleradiology business, and we knew that private equity had bought one of their main competitors, and that one of their other competitors was up for sale. So we knew there'd be some interest in the space last year. Because we had, we're the largest shareholder, because we had essentially, not quite, but almost a blocking stake on a transaction. The advisors and the potential buyers and the board all knew that they needed to get us on board, and we'd sort of been quite clear about what our expectations were, and that we understood what the benchmarking for private market deals was. And so that business got taken out at a multiple which was very similar to the multiple that two of its competitors have been bought by private equity in the last couple of years. So we knew that was a sensible benchmark price, where they'd had profit. They had Evercore as investment banks were advising the board on their position, either as sort of for defence or to sort of evaluate an offer. And so we knew that was a good price. In contrast, Equinity, which was a business where which I inherited actually when I first took over the fund. So it was, I think, a position that had been acquired by the previous manager. Good business, good market position, bit of a special situation because it had underperformed, and US private equity came to buy that business, and it was a premium. We made money on the investment, but we felt the valuation multiple was really quite underwhelming, and we would have liked it to be a higher price. We made that very clear to the board, but we had a small equity stake in that business because it was a much larger company, and so we weren't in a position to be able to really influence that. And we could give our view, but we couldn't really stop that from being taken private. And that's a really that contrast between Medica and Equinity is a really sort of useful illustration of the kind of way we've evolved the strategy. The strategy of the as you read it in the prospectus, it's been the same for a number of years for this fund. But since we took it over 4 years ago, we decided to reduce the average market cap of the portfolio companies and increase the average equity stake. And the reason we did that is because we felt the size of the fund, size of the companies, if we're targeting companies that are between 100 and 300 million market cap at the point when we invest, we can either specifically through SEC or in conjunction with some of our other funds, we can take a larger equity stake, and that equity stake gives you much more influence in that kind of situation. So with Medica, we were pivotal to whether that happened or not. With Equinity, we weren't.
Great, thank you. There's a question here about, so it's a property franchise merged with Belvoir. So what was the attraction of that deal, and what do you think the outlook for that business is now?
Well, there's this. So we had historically had shareholdings in both businesses through our other funds, and we've been shareholders for a number of years. So we knew them really well. They'd flirted with a sort of combination of two businesses a few years ago, but it hadn't happened when they were much smaller for various reasons. They're both founder-led businesses, and founders were both chairs of the businesses and had large stakes, so it was sort of tricky to make it work. But we've always thought that there was a sort of significant opportunity of putting the two businesses together because they're both franchise state agency businesses, very skewed towards lettings. And lettings has much better quality of earnings because it's much more repeat and recurring. So franchise model is attractive because it's very cash generative. You're one step removed from the kind of ultimate profitability of any individual site because that's the franchisee's problem. You're just taking a sort of proportion of the revenue in exchange for being part of your network and giving them the support and services and brand, etc. And there was two of these networks that were both national, and when you put the two together, you don't need to have, there's a lot of duplicated costs at the center. So we think there's significant synergies from a cost perspective of putting two businesses together, not least sort of have the PLC costs, which are kind of very easy to take out very quickly. But we also think there's significant revenue synergies of putting the two businesses together because there's a financial services opportunity attached to a state agency, which Belvoir had been quite good at exploiting, but TPFG had been less good at. And so the Belvoir sort of MD, who was specifically in charge of financial services proposition, is now sort of on the main board of the combined group, and she's really sort of tasked with driving that opportunity across the wider platform. So we think we put 2 and 2 together, and it's genuine sort of 2 and 2 equals 5, if not 6, because there's cost synergies, there's revenue synergies, and now the business has gone from being two sort of sub 100 million market cap companies to being one sort of over 200 million market cap company. So it's on the radar for more investors, and the multiple sort of is very undemanding for what we think is a very high quality business in terms of fundamentals, financial profile, market position, and the opportunity to grow over the next few years. So we're really excited. And so we bought a position in both businesses, and we really encouraged them to, we made it very clear that we would be very welcoming of the combination, and so that's eventually happened after a number of years of sort of flirting.
Great, thank you. I mean, it's a great story. I suppose one of the things that people are bound to wonder about, and you tackled this slightly here, but do you see an obvious catalyst for re-rating a UK market now?
Well, as I said before, I can't call timing, but I think the valuation gap is so significant, and it's attracting, it's really noticeably attracting sort of everyone except for your kind of your natural UK equity investors. So whilst there's been outflows from UK funds and sort of the wealth management space has been sort of re-benchmarking to global indices and sort of buying more US. My view is not really the right time to be doing that. And that valuation gap is meaning that private equity and corporates are seeing the opportunities, and the sort of steady stream of takeovers we're seeing at elevated premiums as well. So the average premium for a takeover during 2023, I think, was 52%, and that compares to 40% premium sort of on average for takeovers over the last 5 years. And I think it's a bit below that if you go back further than that. So you're getting elevated premiums, which is a really indicator of the value opportunity. Eventually, that will cause people to allocate back to this area, and that will drive a re-rating. When that's going to happen, I can't really call. But we don't need it to happen because because of this takeover dynamic. There's an opportunity for us to get the right multiple for a company in a takeover situation like we did with Medica, or there's opportunities for us to really support the company to do the right things to really get the story out there and to stimulate incremental interest and as they make progress, you will see a natural re-rating as well. And so there's something like Fintel, that's been the case, and it was on a pretty low valuation, was very unloved when we first invested, but it's really delivered on the strategy, and that strategy was a strategy to evolve the business to structurally higher multiple type business, and they've done that quite successfully.
Great, thank you, Ken. That's all really interesting, and well done. And I hope it keeps going. We'll get you back on again in a year or so and see how it's.
Okay. Well,
yeah.
Hopefully we'll have a bit more interest in the UK small cap sector by then, and it's more widely. But yeah, thank you.
Yeah, fingers crossed. Thank you. So we'll be back next week. Andrew McCarthy's with us next week, as usual, 3rd of May. And our guest next week is going to be the manager of Gulf Investment Fund, which is obviously one of the best performing funds out there. And then another really good performing fund. Well, actually, a run of them. So Literacy Capital the week after, and then Manchester London the week after that. So a good lineup, I think. And have a great weekend. And I will talk to you next Friday. Bye-bye.